I think that if you back it up and look at what happened from 2007 up until the end of last year, there was a very large rotation out of European and US stocks into emerging markets because of the crisis in America, which was followed, of course, by a recession. And then we got hit by another crisis in Europe, which was also followed by a recession. But the important point is that both of those major economies, and they are, after all, the first and second largest economies in the world, are coming out of their recessions. And so that massive amount of money that moved into emerging markets seeking refuge from the turmoil and recession in the West is therefore vulnerable. I think that the markets here in Asia doesn't necessarily mean they collapse, but you will continue to see, at least in relative terms, underperformance versus the developed markets. Well, I think it is the tapering. I think the tapering would be the beginning of a reversal of the amazingly accommodative central bank policy that's been in place. Really, it even goes before the global financial crisis. It's 10 years now that we've had essentially very loose monetary policy. And so I think that everybody would immediately make the connection between tapering and the Federal Reserve's what do they call it? Their prime interest rate starting to move up, and that I think would be another tough event for the emerging market space. And as I say, I don't see in the Fed numbers now, in the targets that they've specified, this happening before June. But they can and often do change their mind. They may say tomorrow that they no longer need to see inflation at 2% or unemployment at 6%. So I believe the emerging markets are still vulnerable to this impending reversal in Federal Reserve policy.